Welcome to Mad Money. Welcome to Cramer. I'll be my friends. I'm just trying to make you a little money. My job is not just to entertain, but to teach you. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. You can always find something wrong if you really want to. It's so easy that you can gin up mistakes on a daily basis. Funny thing, though, what went wrong goes right. Nobody acknowledged it. The hurdle was overcome. That's the worst case never happened. Never acknowledged. And that's how you can end up with days like today, where the Dow gained 114 points, S&P advanced 0.21%, NASDAQ jumped 0.45%, despite an overwhelming chatter of negativity at the opening from both analysts and the media. Front and center, let's talk about the bond market for a moment. I always like to remind you that bonds are more important than stocks. They're determinants. They're much bigger than bonds, but they're much bigger than stocks. They're supposed to tell you what happens next. But lately, bonds have been consistently wrong. They haven't helped you at all to make money in stocks. Instead, they keep encouraging you to trade the wrong way. A few weeks ago, we came in every day, and saw that the 10-year Treasury yield kept climbing ever higher. Each tick drove stocks lower. We seemed doomed. Yet in the last few days, yields have plummeted. And today we hit a level that we haven't seen since April 7th, when we thought we were going into a tariff-induced recession after Liberation Day. That's right. The yield on the 10-year is back to where it was when we thought we were facing Armageddon. This time, it's thanks to a weaker set of employment numbers, much less dangerous and certainly reversible. Something that was horrible morphed into something fabulous. But it wasn't even noticed. And the people who were saying, well, they're gone. Now, I've had the tape rewound for things that I've said wrong, and I own them. I try to get more right than wrong, okay? However, I expect to be called out when I make a mistake. No one called out the boys who cried wolves about the bonds, though. Yet I'm sure many of you sold things because you heard that interest rates were rising at unheard of levels. Hey, by the way, it didn't matter that we actually had heard of them. It's just that they were heard 30 years ago. Now, I traded through that period, so I know that 10-year going to 5% wasn't the end of the world. In fact, it was actually a halcyon time to make money. For weeks, we were told that rates were skyrocketing, and honestly, some of the media reported it that way in order, I think, I'm not kidding, to scare you. Evidence? Well, let me give you an analogy, a little personal history. Way back in the day, I covered homicide when I lived in my car in Los Angeles. Sometimes I cover, unfortunately, a string of homicides, all separate. My editor said, hey, how do you know they aren't all being done by one killer? I told them what the police told me, different MO, everything different. My editor said, why should we believe the police? Next thing you know, I was writing about a serial killer because you know why? Serial killers sell newspapers. I hated myself, and I really hated my editor. But the paper was doing badly, so the truth was sacrificed. I don't forget things like that. That's why I don't do it. Back to bonds. There were plenty of people on air and in print that wanted to tell a scary story. I know, seems ludicrous. But believe me, everyone wants to write an interesting story, and scary is interesting. Things are asymmetrical. Those who talked and wrote and screamed about skyrocketing interest rates had no price to pay. It wasn't as egregious as making up a serial killer, but it did hurt a lot of pocketbooks and wallets, maybe yours. I never heard a soul say it was time to buy bonds. All right, not just bonds. Let's go to the Mag 7. Go back to the spring and recall where Alphabet was trading. Can't recall? I can tell you. It was at 140 and change. What were we hearing? That it was monopolist, that it will be punished by the judiciary, that it was that the breakup will make no one money. No sum of the parts. Just a breakup that was punitive, so the stock had to be sold. Just an expensive stock that was about to be hobbled by the government. Sell.
The House of Pain.
In retrospect, Alphabet was never really expensive. It still isn't, even up here at $234. I know it's almost inconceivable that the judge who ruled that Alphabet was a bad actor monopolist, then turned around and said the events had overrun the status, so it was no longer a bad actor monopolist. But here we are a few weeks later, and all we seem to be taking for granted the stock's in the 200s. We don't say, ooh, wow, that's scary. That move occurred without a moment of remorse from those who said it couldn't happen, or that the stock was dangerous in the 140s, 150s, 160s, 170s. Now, I made a negative call for Alphabet for the CNBC Investing Club, but at least I publicly beat myself up for getting it wrong. So what? Periodically, you know what? You have to hate yourself. That makes you better. Makes you more honest. Now we got another one, Amazon. A few weeks ago, this stock was plummeting. Why? Because we heard that Amazon Web Services was falling behind Microsoft's Azure, something that actually we picked up loud and clear on this show from Snowflake's explosive conference call. It didn't help when a Morgan Stanley analyst asked Amazon CEO Andy Jassy if he was worried about falling behind And Andy didn't say, quote, we are spending and getting a great return on our spending, whether it's on our trading interests or Nvidia chips. He didn't say that. The street was quick to hammer the stock because he didn't say that. Here we are a couple weeks later, and Amazon stock's at 235 and change. It's knocking on the door of 242. It's all-time high. What changed? Nothing. Nothing at all. The market simply moved on from the bear narrative because there's so much good that's happening at Amazon. So much good. Who knows how much more revenue Amazon can bring in from Prime starting October 1 now that you can share you can't share your password with relatives. Did you know that? I think it could be like Netflix. We had this huge surge of subscribers. Be long Amazon. What really was wrong with Amazon again? I can't remember. Or how about this one? Back in August, we heard that Apple had run out of growth and had nothing in the hopper. That was like a continuous loop of negativity every time you raise your head. If you were an Apple shareholder, a sharpshooter who wanted to sell a lot of paper shot you down. Here we are more than 30 points later, and we know that Apple can receive a check from Alphabet to preload Google into their 2 billion devices, something that everyone thought would be scrapped by the judge who found Alphabet a monopolist. That's more than $20 billion. What profit margin that is. Nope, in the craziest of torture circular thinking, the judge ruled that Alphabet would have enough money to be even more of a monopolist if it didn't pay Apple. God, what terrible reasoning that is. Those noisy souls who believed in trading Apple and not owning it, they were never skewered. They sold a lot of papers. Hopefully they didn't catch the 30 points the believers captured. Which brings me, of course, to Nvidia. Here's a stock that's going straight down for 4 straight weeks, despite a very good quarter in the middle of that skid. Today, Citi lowered its price target from 210 to 200, broke ranks, but much less bullish than everybody else. It got picked up. This price target cut got picked up by everyone. All I heard about today was that Broadcom is now a factor taking share from Nvidia, maybe big share. Apparently, it is a horse race. Okay, let me tell you something. Broadcom is the biggest position for my charitable trust. Oh, we love it for the club. It's a fantastic story of private label chips. However, I got real bad news for those who are trading, not owning Nvidia. The price performance of Nvidia is so much better than any other company, including the one that's our larger position, that we say we don't care. I got another idea. Why not own both? Today was the Citi analyst day to shine. Oh, yeah, after 4 weeks down for Nvidia, he really nailed it. Did I mention that he lowered his price target and then the stock actually finished up on the day? But he did break ranks. The bottom line, I bet we'll look back on that Citi price target cut and realize it was a mistake, just like the others. But boy, oh boy, again, like the others, did it ever sell a lot of papers. Steve in Florida. Steve.
Hi, Jim. How are you doing?
I'm doing well, Steve. How about you?
Good, good. I've been following a stock which has increased sales 30% in each of the last 6 quarters. They have also increased their largest customers, those having annual recurring revenue of greater than $100,000, to 2,770 customers, with an average amount of $350,000 in sales each.
Okay, and that is?
The stock is Samsara.
Man, that company had a great quarter. And I saw the CEO, and he did a fantastic job. I salute him, and I salute the company. All right, so if you look hard enough, you can always find something that's wrong. I don't want to shake you out of a market where people are ginning up negative stories. It's a surefire way to lose out on opportunities in this market, and I know you've lost out on many of them. But I can hear your complaints right here, like in my molar. All right, on Mad Money tonight, it's gearing up to be a huge week for the IPO market. I'm giving you everything you need to know to be prepared for these big debuts, and they are something. Then the S&P 500 is gaining 3 new members. I'm going to go through the latest stocks to join the exclusive club, see what you think. I'm going to give you my take. And as Kava continues its expansion, how are the different parts of this country reacting to this Mediterranean-style fast casual option? I'm talking to the CEO to get the latest. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.